o'clock.
Well, good afternoon, ladies and gentlemen, and welcome to this our third in a series of working lunches today in association with our partners at Schroders. ESG fund selection seems to be on the agenda more and more. And I'm just quoting from you a couple of surveys that have come out this month, which are, I think, quite interesting statistics. 40% of clients say that COVID-19 has made them think more about investing sustainably. 83% of advice users say they value a conversation with an advisor about sustainable investing. And yet, from another survey, only 18% of advisors said that ESG advice was already fully integrated into their business. Some interesting stats. We've got, I hope, an interesting hour ahead of you. Welcome everybody. My name's Andrew O'Kelly with Professional Advisor, and I'll be chairing the lunch today. We've got three great speakers for you this afternoon. From Schroders, we have their UK Intermediary Solutions Director, Gillian Hepburn. The Portfolio Director at Cazenove Capital, Emily Shaw. And putting up the case for the advisors and what have you, a great friend of professional advisors, Philip Martin, the Managing Director of Unique Financial Planning. Before we get into the event, I just need to go through one or two housekeeping bits and pieces with you. Your microphones are currently turned off. We'd appreciate if you could keep it that way. It just saves any background noise, phones ringing, what have you. Please add your full name. What do I mean by that? In order that we can send you your CPD certificate, we need to know who you are. And as I look through the list of participants at the moment, I can see one or two where we just have your first name, or occasionally there might be one that says user. That doesn't really help us to identify who you are. And if you want us to send your certificate, then we need you to put in your full name at any time during the next hour. The way you do that is you go to the list of participants at the bottom of your page, click on your own name, and where it says more, it allows you then to rename. And if you'd be kind enough to give us your full name, we can match that up with our registration database and send you your CPD certificate later. There will be a Q&A session, which will run at the end of today's meeting. And I'd appreciate it if you would address your questions to me. That'll come in through the chat function, which you'll find at the bottom of your screen. And if you could address them to me, Andrew O'Kelly, I promise to make sure that I pose all of your questions to our panel at the end. I should let you know that this event's being recorded for CPD purposes. We'll be sending you a link to the recording later on. And talking of CPD, you will have 1 hour's CPD by virtue of attending this event, and we'll send you your CPD proof of attendance within 24 hours of being at the event. So in true CPD style, let's whip through the learning objectives and then get into the meat of the event. We'll be looking at definitions. Is it a challenge, and can we work towards further consistency? We'll take a look at client conversations. Are you ready for MiFID II regulations and sustainable preferences being included in suitability discussions? There will be some questions for providers, no doubt. Process and methodology for assessing ESG, levels of engagement and track record of influencing change, and can you spot the experts? We'll take a look at reporting and how can you reassure clients that their investments have an impact and are making a difference. And lastly, we'll take a look at performance and look at whether performance drag is a myth when investing sustainably. So those are our learning objectives. We've got just under an hour to go. So let's crack into the main part of the webinar. And first of all, I'd like to introduce from Unique Financial Planning, their Managing Director, Philip Martin, who will tell us a little bit about his business and what he's doing on this call. Philip.
Thanks, Andrew, and good afternoon, everyone. I thought it might be helpful to explain, actually, partially because of some of the limitations about how much we actually touch ESG. I run a business called Unique Financial Planning. We've got 32 advisors based out of 4 offices in the south, in in Hampshire, in Dorset, in Oxfordshire, and in Surrey. And we're a broad-based business, so as well as undertaking investment and pensions advice, we also give mortgage advice and protection and general insurance, although the overwhelming majority of my advisors have an investment licence. We don't have a specialism in ESG. It's not how we set our stall out. It wouldn't be our core investment offering, but we do have some thoughts on it, and we do have some quite specific examples of where we're now seeing clients, and in particular, the potential inheritors of clients starting to get far more interested in this space. So we wouldn't be an expert firm in this space, but it's definitely touching us increasingly. So with that background, I'll hand over to you, Gillian, because I know you've got some background to the shape of the market and some interesting numbers to share with us.
Thank you very much, Philip, and good afternoon, everybody, from a very rainy Scotland. I'm delighted also to be joined by Emily Shaw, who's a colleague of mine. We've worked very closely on sustainability. I have to say I've learned loads from her over the last year and a half, so I thought it would be really good to get an absolute expert on the call to join me this afternoon. But just to kick off, obviously we've got a number of different topics that we're going to cover, the first being definitions. I think certainly from the conversations that I have with advisors, there's a whole range of different definitions being used within the industry, and that also gives them challenges, I guess, with some of the conversations that they might need to have or want to have with clients. So I just thought, before I'm going to get Emily to talk in a bit more detail about this, for us at Schroders, I guess the key message is sustainability as it is at the heart of everything we do. It informs our investment process. So not only is it about delivering risk-adjusted returns, it's about using sustainability to help us manage risks and maximise opportunities. But taking that a stage further, it's also about helping those clients who have a clear intention, I guess, to make a positive impact on what we describe as planet and people. And we'll come on to that in a minute or two. But why planet and people? And I guess society and the planet we're facing significant challenges at the moment. Things like inequality, poverty, climate change, and we can all make choices as how we contribute towards this, but including it within our investment strategy is something that we are certainly seeing more and more of. But what does it mean in reality? And in terms of some of the, I guess, the terminology that we use with clients, I'm going to get Emily to just cover this, and then Philip, perhaps you could come in after Emily and talk about how this relates to some of the discussions that you're having with clients. Emily, over to you.
Thank you, Gillian. So I think this sets the background for having understood that your client actually wants to invest in a way that creates positive outcomes for people and the planet. How can you then achieve that? And first and foremost, you need to understand your intention, and primarily that is to avoid harm. You cannot be investing in a way that creates positive outcomes for society if you're investing in things that are having a negative contribution. And how can you do that? Well, you can avoid things that create harm by understanding environmental, social and governance trends and companies' practices, and how their products and services and practices are contributing to society. And by understanding that, you can then strip out the ones who are causing harm. So that is quite traditionally known as negative exclusions and ESG integration. And that's the primary way that you can avoid harm within a mandate. You then want to be able to go that step further and actually see that you're creating benefits for people and the planet. And you can do that by investing in companies who put stakeholder value creation at the forefront of what they do. And just as a recap, a stakeholder is anyone that the company is impacting by being in operation. And that will include the likes of your employees, your suppliers, your customers, the regulators, your shareholders, and the environment and broader society. And then where possible, you actually want to contribute towards solutions to environmental and social need by investing in those more impact-orientated investments. And you can do this by identifying key environmental or social trends, such as water scarcity or health or well-being, and investing in that within your portfolio. and those more socially orientated investments where there's a very clear purpose towards the capital allocation, and that's through things like social or environmental bonds. So for us, this is how we draw out the spectrum of sustainability when we're looking to construct a portfolio. First of all, understand our intentions, avoiding harm, benefiting stakeholders and contributing towards solutions, and then how we can achieve that through the various strategies. And this will be really helpful for you because most funds will show which area of the spectrum they are geared towards within their own policies. So it will enable you to identify which part of the parcel and which strategy you're employing for your client.
So Philip, obviously you're at the sharp end of all of this, because one of the things as a provider is we've got to make sure that we speak in language that helps you then have conversations with clients. And where do you think this fits with some of the conversations that you're having with your own clients?
Well, I think it fits. I think it fits in two ways. I mean, I think as a general trend, we are seeing increased interest, even just questioning on why an investment proposition is the way that it is. And I think there's quite a heavy generational bias on that. So as we start to do more work with the children and the inheritors of existing clients, it's quite clear that they view where their money is put to work in a very, very different way to the generation before. So we need to have a solution that better fits their aspirations. I think I'm very, very interested in Emily's slide here around impact. For me, I think this is the absolute missing piece between a slightly nebulous concept and actually articulating what good collectively the money, when put together in a mutual fund, is actually doing. And I think it's even more important when you start to address the concerns that many clients have around the specifics of individual investments, because if we were to ask 10 different clients what they would like to see and what they would not like to see in a portfolio, we will get 10 different answers. Therefore, in a mutual fund environment, you've got to be able to plough your way through the middle. And I think the one way of bridging that around the selection that you make and making it real is by being able to, in a numerical way, assess the impact that the companies themselves are making. So I think this is an absolutely vital part of the development of this part of the sector.
Just to highlight, sorry, Gillian, I just wanted to add one point on highlighting the importance of actually the impact side of this form of investing. It's estimated that we need an additional $5 to $7 trillion of annual investment in order to achieve the United Nations Sustainable Development Goals. Now, that is not all going to come from governments. They simply couldn't afford it. So there is an expectation that the investment industry will help fulfill that need by allocating our capital towards these solutions. And you can do that through mainstream investments because there's been a huge amount of increase in actual investment solutions where you can see that measurable positive underlying impact that's coming from that capital allocation whilst still generating a return. And I think that's what's really accelerated the amount of interest that we've seen coming from clients as well.
I think, I mean, the other observation I'll make on this, and I suspect we'll touch on this over the rest of the discussion actually, is that properly assessing impact will sort out the wheat from the chaff. Clearly, ESG is the big buzz thing in the asset management industry just now, and there will be the normal fair share of charlatans and wannabes who will take existing stuff, badge it up with what looks like ESG and try and pass off existing capability as some sort of expertise. I think people who do impact properly, measure it properly and report it consistently, particularly if it has an external validation to it, I think will be able to differentiate themselves quite clearly from, let's say, the second or third rate operators who will try to jump on the bandwagon.
Yeah, I completely agree. We're going to look at and some of that later on. So I think in particular transparency of what we do, how we do it, and how we measure it is really important, and how we can translate that back to helping advisors have good quality conversations around this. But I think what we're all agreeing is that the conversation has moved away from what we would call And I've been in the industry a long time and launched ethical funds a number of years ago, where it was all about just negative screening and taking things out. And I think now it's all about, not just excluding, but including, and how do we develop solutions that actually do something positive. So we'll look at all of this. But I just wanted to go back a step in terms of just the whole debate. And it was interesting. We ran a survey earlier this year, particularly around the recent coronavirus pandemic, and asked advisors a number of questions. And what came through loud and clear was that the situation had, I guess, woken people up to thinking about working with asset managers who actively engaged. If you look at some of the stats on this slide, advisors were telling us that they really agreed that they needed to engage with companies who demonstrated stewardship and governance, and also that the crisis made them pay a bit more attention to ESG factors and risks associated with investments. So that was advisors beginning to really think a bit differently, I think, certainly in terms of the work that we were doing. But Philip, in terms of clients, what are you seeing in terms of some of the client demand for solutions? Because I think for us as a deliverer, a provider of solutions, it can be quite challenging to make sure we deliver the right, the right propositions for clients and for advisors.
So I think we're at, I don't think we're quite at the crossover point yet. I think far from it. So for us as a business, we're viewing ESG in a different way to the way that your preamble determined that Schroders is looking at it. It's not embedded in everything we're doing. We wouldn't have any more than 15 clients in 100, even even at that level, who would ever even raise it as a potential alternative. But that is definitely rising over time, and clearly there's going to come a point over the next 2 to 3 years where it needs to be embedded as a core part of our investment offering. I think actually it will end up happening not as an alternative. It won't be you can have the non-ESG portfolio or you can have the ESG one. I just think that portfolios themselves will start to be constructed far more with underlying building blocks that pass an ESG test. And I think that would be better for the industry if it did, because then it would be seen far more as core rather than peripheral to a core offer. It would be more deeply embedded. So we've just begun to think, how would we be changing client portfolios to start to embed this into everyone's portfolio, irrespective of whether they'd expressed an interest in it or not. But we're not there yet.
You've made a couple of...
We'd still be a couple of years off, I suspect.
Yeah, so there's two really good points there. One is you talked about actually it'll just become almost business as usual, and it's something that Peter Harrison, our CEO, has talked about, that in his view ESG won't exist in 5 years. It because the conversation and the debate will have moved on to impact, and ESG will just be something that we do. But secondly, the client conversations. I mean, obviously the MiFID II changes coming into play, where client sustainability preferences need to be taken account of, are also driving some of these conversations. And it's something that we've talked a lot about in terms of how that client conversation should evolve, because clearly if we're saying to clients, what do you not want to include, you could actually get to a point where it's very difficult to provide a solution that meets all of their requirements, other than, say, a bespoke portfolio, which is not necessarily appropriate for everybody. So that the challenge therefore is delivering, I think, packaged solutions whereby we can meet as many of the requirements for clients as possible. I don't know, Philip, if you've had any of those kind of conversations with clients yet.
Not quite as specifically as that, but I think the one other thing that I think providers will have to think about is the extent to which they can actually be ahead of client thinking on how some of these portfolios are constructed. So at the moment, decisions about how to screen and how to include or exclude are very much taken by a very different generation that I think is ultimately going to be investing in this in the next few years. I was at an interesting event about 6-9 months ago, where somebody pointed out, a behavioural person pointed out, that the single biggest cohort of millennials that could be identified as having a like characteristic were actually vegans. So what does that say for us investing in sausage case manufacturers, for example? And I just know that won't currently be thinking that's taking place in screening, yet I know in 5 years' time that absolutely will be a question that's posed of me by that cohort of client.
Can I just weigh in there? So I think what you're identifying there, actually, Philip, is that ESG in its traditional form is a financial tool. It is the understanding of environmental, social and governance trends and how businesses are adapting their business models in order to incorporate those trends so that we can better, as an investment manager, identify risks and opportunities. And what you've just said there with people, moving away from the meat industry, that's a risk to that sausage maker. And therefore we need to incorporate that into our investment decisions when we're constructing our portfolio. So that's ESG in its purest form. It's a financial instrument to improve our long-term performance. It's not designed around saying, okay, well, this company is creating a product that's very profitable, but we know it has a negative impact on society, and therefore we're not going to own it. That is what sustainable investment looks to focus on. So moving away just from identifying the risks and opportunities and actually thinking about maximizing the impact of your underlying portfolio. And I think that lends itself to the point that ESG will absolutely become mainstream as environmental and social trends accelerate and become more influential to markets. It would just be common practice that we're putting consideration to them within investment construction. But we see that there's a growing demand for actually those more impactful investments and moving along the spectrum. And I think that's why the likes of Peter Harrison is saying ESG will be mainstream and the focus will become on impact investing.
Yeah, I totally agree with that. Totally agree with that.
So one of the other things, Philip, that you talked about there was, how can managers actually demonstrate what they're doing and how they're doing it? And this is all about, I think, what are the kind of questions that advisors should be asking of providers to make sure that they are selecting the right investments for their clients. We put some suggestions here. I'm going to ask Emily in a minute or two to talk about some of this in more detail, but it's all around, can that manager demonstrate a clear ESG policy that's consistent with their beliefs, objectives and circumstances. Are they signed up to certain stewardship codes, governance principles, or responsible investing? Do they actively take part in industry organisations and initiatives, and what does transparency look like in terms of stewardship activities? And it's really important, I guess, and I think this is what you were saying, Philip, these aren't just glib statements, that providers can actually demonstrate this and demonstrate not just that they take part, but they've got a track record in actually influencing and making a difference, if that makes sense. Is that is this helping in terms of shaping that conversation, Philip?
It is, because there has to be a rationale. I mean, in effect, what you're doing here is identifying what are the key aspects of due diligence that you'd want to do in selecting a mutual fund provider. What's their credibility in this space? I mean, we've discussed this before, Gillian. I mean, I think it's going to be very important as more and more people seek to get into this area. It's all very well talking about the fact that you're able to engage with companies and to start to effect some positive change from within the boardroom. But that really only applies to two types of asset manager. They're either enormous globally and hold that stock across a number of different portfolios and therefore have a disproportionate share of voice, or they're a boutique provider where they have, again, that disproportionate share of voice. And I think in the latter case, for example, I mean, they wouldn't thank me for calling them a boutique, but Baillie Gifford, for example, with Scottish Mortgage, I understand is the biggest single holder of Tesla stock. And if the Scottish Mortgage manager wants to speak to Elon Musk, he calls him up and he speaks to him. You can't think of a better way for them to start to effect some change through the pooling of customer assets. And to me, that is absolutely vital in this space. Otherwise, people are just talking about it, but the reality is they don't have the share of voice that other providers potentially do. It's a vital part of due diligence, I think.
Emily, I mean, this is obviously an example of sustainability at Schroders, but I think it's important to give everybody a feel for maybe the sort of data and information that they should be expecting their provider to deliver for them. Emily, do you want to talk about some of this for us?
Yeah, absolutely. So probably worth saying that I work for Cazenove Capital, which is the wealth management arm of the Schroders Group, but Cazenove itself is actually an independent, and we are open architecture. So we're not beholden to only invest in Schroder funds, and the majority of what we do is investing in third-party managers. And I'm actually chair of our Sustainable Investment Committee, and our sole responsibility is selecting sustainable and impact funds. So as you can imagine, I've seen quite a range of different expertise and capabilities across the market. And I think the key things that we look for is, first and foremost, that there is evidence of a commitment to ESG and sustainable investment at the firm level, and then how that manager is integrating ESG and sustainable investment selection into their strategy. And at the firm level, key things to look out for are the initiatives that they have signed up to. Things like being a United Nations Principles of Responsible Investment Association signatory is essentially vital. If you're not a signatory, I think you need to be answering why, rather than just it being a nice to have, as well as other important industry initiatives such as climate action and aiming for A, and all of these great collaborative initiatives which are pooling the voice of the asset management industry together. And then you can quite clearly see how much resource they dedicate towards this area, and importantly, evidence of their engagement activities. And back to your point, Philip, we are very stringent on getting evidence from our asset managers that they are actively engaging with companies and the results of those engagements. And you can see here on this slide, we've just outlined some of the key capabilities of Schroders Group, but it just highlights quite nicely that there's a huge amount of resource that's dedicated towards this, a huge amount of active ownership going on, industry initiatives that we have signed up to and been awarded top accreditations from, as well as engagement activities and results. And these are the kind of key things that you need to be looking for from managers. And in terms, happy to go along, Gillian, in terms of being transparent about our engagement activities, I think this is of real importance. Lots of managers might quote the number of engagements they do or particular statistics, but they won't actually give you underlying detail. We think it's really important to actually give that underlying detail, as well as the impact that it is creating. And you can see here, we've highlighted a couple of our recent engagements as a firm. We've been helping to tackle evidence of modern slavery within supply chains, and supported a collaborative engagement with a number of other investment bodies to ask companies to improve their modern slavery statements. And actually from that particular engagement, out of the 18 companies we contacted, 15 have already improved their own practices. And one that I'm particularly proud of, we believe in diverse boards. We think it's essentially essential in order to make better decisions. And on that basis, we wrote to all of our US companies where they only had men on their boards, and said to them, if they did not make a change, we would look to vote against the chairman of the nominees committee at their next AGM. That's obviously quite a powerful statement when you're a very big asset owner, and it's already resulted in 30 out of the 40 companies we contacted appointing a woman to their boards. So transparency on engagement activity is absolutely essential, and it's really meaningful to your clients as well, because then you can take these case studies and report back to them, and it shows them that there is this real impact coming from that engagement activity.
Philip, do you think that's the kind of evidence that you would like to be able to present to clients, or that they're expecting to see if they're making specific investments?
It's exactly it. I mean, I think I'd present it in a different way to a client, obviously, but it's exactly
sure, yeah.
what you would want to see as the gatekeeper to a potential solution. It's picked up on every point I was talking about just a moment ago. Perfect.
Yeah. And one of the other things I mentioned in the earlier slide there was around having a sustainable investment policy. And again, we've just put here what might be some of the things that you would look for. It's one thing asking for the policy, but what might you expect to see? Emily, do you want to just outline some of these areas for us?
Yeah, absolutely. And this is really important for understanding the strategy that's being employed by the fund that you're looking to invest in. And this is an example of the responsible investment policies that our core collective vehicles adhere to. And first of all, we've quite clearly set out that our intention is to meet the financial objectives whilst also having a positive impact on people and the planet. And we will do this by avoiding harm, benefiting stakeholders, and contributing towards solutions. We are integrating ESG across all asset classes, as well as using our influence as an active owner to encourage companies to make progress. We've also committed to supporting the Paris Agreement on climate change by reducing portfolio emissions and advancing the energy transition through influence and investment. And then we quite clearly set out the areas that we will not invest in. So here's our formal exclusion list. And I think it's really important to get clarity on what the responsible investment policy is, so that you can obviously report that back to your clients and ensure that it meets their expectations and requirements, and then hold the asset manager to that policy. So for instance, if we purchased a fund and they didn't have a fossil fuel restriction in their policy, and then down the line we see that actually they have fossil fuels, and we query that because that's not really in our view sustainable investment, but they haven't at any point said that they wouldn't invest in that, actually that should be permissible because they've made it quite clear what they will and won't own.
Philip, see, obviously the list on the right-hand side in terms of inclusions is interesting because I think often people still assume that this is just all about excluding certain industries. Do you think with clients that the conversation is really starting to move on now from that?
Perhaps not. I mean, perhaps, but I think there's so I'm hesitating there because I think still in a client's mindset, this is all about where I don't want my money to be, rather than the different lens of where I do want my money to be because of the change it's having. So, I mean, I think the industry itself is going to have to invest pretty heavily in direct to consumer educational understanding, I think, over the next 18, 24, 36 months to try and get people to view it from a different lens. It is very much seen still as where I don't want the cash to be rather than where I do. And it's obviously a far more positive conversation to be having with clients about the positivity around where your money is, rather than spending 15 minutes writing a list of where it isn't to be, if you know what I mean.
Yeah, absolutely. And even, Emily, you and I have been in a number of conversations around our own investments, the model portfolios, where the actual underlying holdings were challenged, weren't they, in terms of what we were holding and why, and some of the detail. I don't know if you want to just cover some of the high level examples, because I think it is, some of the measurement, there is divergence, I could call it, across the industry, and some of the assessments are or can be quite different and quite subjective, which continues to make this a bit of a challenge for everybody involved.
It is the biggest challenge because it is subjective. There's no one single view on what is a sustainable company. And actually, I think even if you looked at the best kind of B corporations, you could find fault in them at some point down, within their history or within their current practices, because unfortunately, no company is entirely perfect. But what you need to be doing is making a rounded assessment and determining that actually that company on the whole is creating positive outcomes, and that there's a clear commitment to improving practices where they are lagging. And you will always get challenged. And as long as you have that evidence to back up that you've done that assessment and you've reviewed the weaknesses and made the conclusion that actually they don't contradict the overall commitment to positivity, then it's okay. And the kind of companies we've been challenged on previously, Gillian, is ones like Nestle, you know, lots of use of water, lots of use of plastics, things like this. It's not a company that falls within this exclusion list, so, you know, it wouldn't be picked up as a traditional sin stock, but obviously there are weaknesses there. And in those instances, we were able to share the assessments that we'd done of the overall business, and why we believed it to be sustainable. But you will always get very, very strong opinions, and I think it's just making sure that you can evidence that you've done that assessment and come to a sound conclusion based on real evidence.
I totally agree with that. I mean, I think I would never want to see this positioned in front of clients as a very black and white issue, because it isn't. It's subject to interpretation. You know, sin stocks absolutely are. You know, if this is a, you know, multi-asset offer, for example, and it invests in government gilts, the government raises cash, you've invested in it, the government takes its cash and buys a sin stock like British Aerospace that sells, you know, guns in the Middle East. Have we just broken it? You know, you've got to recognise that it's far more complex than just saying yes or no in two buckets. I think that's absolutely right.
And I think that's where engagement comes in is particularly important. So we've had a lot of interest in investment in banks, because people have moved on from just thinking about the fossil fuel industry, and loads more clients have adopted a fossil fuel restriction. So, you know, the extractors and producers are out of the portfolio, so they're not worrying about them anymore. But now they're thinking about where they get their money from, and that's the banks. And there's lots of investment in banks in mainstream portfolios. So now it's being heavily criticised that you're buying bank stocks where actually that funding is then going towards the fossil fuel industry. And what we've been doing in our firm is a huge engagement with those companies who are the major funders of fossil fuel extraction and production, and looking at ways in which they're trying to transition away, and in dialogue with those underlying funding companies, and what processes they have in place to demonstrate that there is a commitment to help with the transition away. And where you can see that commitment, then it becomes once again a viable stock. But if you can see that there's actually just no thought process going forward for the future of that industry, then it becomes more of an issue.
I think you've got to keep up. If you're following the advertising and budget spend at the moment, aren't banks responsible for training technophones how to use their iPads and making sure that lonely people in the community are well looked after? I don't think it's anything to do with the things you talked about.
Absolutely. And financial inclusion, and, you know, making sure we have our mortgages, etc. So just there is no black and white. And that's the challenge.
And I think the message here, or one of the key messages here, is, you know, make sure you work with a provider who is prepared to be challenged, who can deliver some of the answers, and is prepared to have a conversation with you, particularly about specific stocks if that's a concern to a client. You know, and we're always certainly happy to do that. So it is important. It's not just about what's written; it's about what's also demonstrated within the business. Isn't that the case, Emily? Certainly, when we work with advisors.
Yeah, well, actually, we quite welcome seeing diverse views, because if everybody had the same view, if there was one single list of here's the most sustainable companies from A to B, that would mean that everybody would be owning the same stocks and there'd be no diversification in the market. And we know that we need diversification, we need differentiation of views in order to facilitate an active market. So we welcome different opinions, but we want to see them justified.
Yeah. Okay. And it's also, at the end of the day, you know, you mentioned commitment and working with these companies, who I think it's often fair to say are on a journey themselves. But if we don't see them delivering what they say they're going to do, then I guess as an active manager, there's always the option of disinvestment, which might be the last resort if we think that things aren't happening that we would like to see. But what's your thoughts on that, Emily?
So I think that engagement and voting are far more powerful to initiate actual change. But if you see continued failed engagements, then the only viable option is to divest. But you just need to be conscious that if all climate conscious investors divested from the fossil fuel industry, then the next AGM for BP and Shell would be pretty easy. There'd be no challenging questions. Yeah. So we have our part to play to make sure that those challenging questions are still being asked. That said, I can completely understand why a number of clients would take the view that they just don't want part of that industry anymore. But in terms of how you can really initiate change, I think that voting and engagement are the best ways to do so.
So Emily, just with a specific recent example, what's happened in the case of Boohoo then, where it has quite clearly been disinvestment? Is that because there was failed engagement and people weren't listening, or people just took the simplest route?
I'll be honest, I think there was a slight lack of engagement previously. So Boohoo was a stock that was holding a number of ethical funds or sustainability funds, and it was often quoted as being a good employer and one that created lots of employment opportunities. The fact that they were then exposed for having some unbelievably controversial employment activities was, you know, in most fund cases, they divested immediately, which signals to me that the managers weren't quite aware of the extent of the problem, and actually, you know, whether the company did a good job at covering it up previously or the managers weren't doing sufficient due diligence on their stocks. I think it's probably a bit of both. And in that case, it initiated an immediate divestment. I think it's very difficult to justify maintaining that stock when you know just how poor those working practices are, because to become an improver, they have such a long way to go. And the fact that they've been hiding that quite successfully was a real concern.
Yeah, not great.
Okay, so we've talked through selecting providers and having discussions with them. What about reporting? I know, Philip, that's something that we get asked a lot about in terms of discussions with clients, and how can we help you as advisors and the industry really demonstrate that their investments are making an impact. Now, we've got a couple of slides here that talk about the impact that investments could make, and I guess it's Emily, you probably, it would be fair to say that these are work in progress, but you know, we're really keen to make sure that we're always delivering what clients and advisors want, and reporting, I think, is really important in this space. What kind of reporting, Philip, do you think clients are expecting to see?
I think it just goes back to the impact point. I mean, I think we're going to come on to investment returns, and I think that's clearly important. I think you've got to dispel the myth that it's constantly going to lag performance. So I think it needs to touch on performance, but I think, you know, quite obviously anything is going to underperform or overperform an underlying index if it's poorly correlated to the index. You can't say with any certainty it's going to be in either direction if it ends up with a concentration. So I think it will partially be around its performance and attribution analysis for why it's performed the way it has. But I think this is what is really important, because I think if you're committing to being part of this universe, understanding what difference it is making by funneling your investments in that way rather than another is what really brings it alive.
Yeah.
And that actually
Emily,
is pictures, not words, often.
Yeah, and that's really helpful to hear back, given what we've been working on. Emily, do you want to talk a little bit about what we've been developing in terms of some of the demonstration of impact, and how we're thinking about the kind of information that clients would like to see?
Absolutely. Well, I think what we and the industry have long been quite good at is drawing out underlying case studies. So we can talk about, you know, the impact of some of the green bonds that we're owning, the social housing, how many people have been housed, how many education facilities have been funded, etc. But it's usually an underlying investment level. And what's been lacking in the market is a total portfolio view, which enables you to get a really good understanding of your total impact and also make a fair comparison against other strategies. So that's what we've really been focusing on recently. And here's a snapshot of some of that total portfolio impact reporting that we've created. You can see on the planetary side, we always think about impact on people and planet. So on the planet side, you can see that we've reduced the carbon footprints by under half of what the global equity market is producing. And what that means is that the companies we've selected have a much lower carbon footprint, whether that be because they've improved their own energy efficiencies, they've moved to renewable sources, etc. And we're also actively investing for the planet through our allocations to the likes of renewable energy generation, green bonds, the energy transition, sustainable farming. And on the people side, we use Schroders' award-winning impact measurement tool called SustainX. And what this tool does is looks at all company activities, from the level of tax they pay, the amount they pay their employees, to their products and services and the impact that they are having, and makes an assessment of the overall net impact of that business on society and whether it's a positive contributor or a negative contributor. And then you can get a total company score for social impact and then amalgamate that at a portfolio level. And you can see that our portfolio is creating 5 times the social value to the Global Equity Index. And that's primarily because we have a high allocation to healthcare and medical provision, companies that pay fairer and higher salaries, as well as innovative and creative solutions. And we're also actively investing for people through our allocation for things like social bonds, social housing, healthcare and education. And then we can quantify that a bit further at portfolio level. So at portfolio level, that means that your carbon savings for every 1 million that's invested is the equivalent of 6 homes, annual energy usage, 11 cars on the road, or planting 839 trees. And the social value that's being created is the equivalent of £34,000, which we like to think of as a 3.5% social dividend on top of your financial return.
Yeah. So Philip, this is the sort of work that we're doing to try and help advisors think about how they communicate to clients. I know you mentioned pictures, but I think actually turning some of the numbers into something that's very tangible can help clients really understand that if they invest sustainably, then they really can make a difference.
You've absolutely got to do that, Gillian. If anyone in this call understands what 51 million tonnes of carbon emissions actually is, then well, we may have some, I may not say that, we may have some physicists on the call, but I certainly haven't the slightest idea. I don't know whether that's good or whether it's bad. It has to be made tangible, I think, doesn't it?
Yeah, which is why we've said equivalent to.
Yeah.
So, you know, and I think that's, I mean, obviously, as I said, work in progress all the time, but the more I think we can deliver this kind of information as an industry, not just as Schroders and Cazenove, the better it's going to be, and people can really understand that their investments can actually make a difference.
And what we're looking to develop going forward is reporting against Sustainable Development Goals. So I mentioned those briefly before, but that's 17 goals that have been set by the United Nations, which are going to help alleviate poverty and inequalities without pushing on our planetary boundaries. And these are, you know, you can link your investments and your capital allocation towards those goals and help progress them. And that's something that we're looking at to reporting on going forward. And I think that's very useful. And you're seeing more and more investment managers adopt that approach.
Yeah, now I'm keen that we allow some time for questions, but obviously just to finish up, we did mention at the beginning of this session that we would have a quick look at performance, and I think it feels to me that across the industry now there is certainly a belief that performance, or there doesn't need to be a drag on performance for clients that are investing sustainably. You would assume that you know, good companies perform well, and this is just an example of certainly one of our strategies in demonstrating how it's performing extremely well, so we're pleased. But again, it's interesting that the MiFID II requirements talk not just about sustainability requirements, but the fact that clients' financial outcomes also need to be met as well. So it's important that we can make sure that we've got the right kind of reporting, both in terms of performance and in terms of impact. You know, Philip, do you think that clients still have a concern or have concerns around performance drag on investments?
Well, I think I alluded to this earlier on. I mean, I think this is all about setting the expectations. If you're going to draw your investments from a curtailed version of a wider index, and it isn't correlated in the same way, then it's going to either underperform or overperform. And none of us can say with any certainty which way that's going to happen. So I think the client expectation has got to realise that there may be a price for deciding to go down that route of having that screening mechanism and choosing that investment philosophy over just investing in the wider marketplace. But there may equally be a gain. And I think provided you can set that expectation at the outset, I don't think you should ever be talking about an assumed performance drag, because you can, well, you're showing a perfect example of where there isn't one. We could probably show equally a chart of where there was one, and that is the reality of non-correlated investments, isn't it? You know, it just is what it is. I can't change that.
Yeah. So Andrew, I'm not sure, we've covered a lot here in the last 40 odd minutes, 45 minutes. Are there questions that have come through that advisors or people on the call want to ask us?
There are indeed, and we've
Excellent.
had plenty of activity on the chat line, so thank you for your participation, everybody. To Gillian, Emily and Philip, thank you. That was a really insightful discussion, I thought. Let's get into the questions. So a question for Emily, I think you sort of covered this during the presentation, but nonetheless, do you find clients are acting on a negative or positive view, i.e. choosing to exclude certain areas rather than invest in positive areas?
I think it's primarily still focused on negative exclusions. They come to us saying, oh, I really don't want to be investing in this, and I've heard about Boohoo and that's awful, and tell me what I definitely won't own. But there are a growing number who are saying, I actually want to use my capital to allocate towards solutions, and I've seen that I can do that and still generate a return. So tell me what I can invest in renewable energy and climate bonds, particularly climate related solutions people are really engaged with. So yes, I think still primarily they're focused on ensuring that they don't own things that they don't agree with, but there's a growing attention on where else they can actually use to invest in a positive way.
Okay, another question now, perhaps for all of you. The FCA were going to include sustainability in its sustainability reports come October that clients had asked about ESG. That's clearly been delayed. Anybody on the panel have any clues as to when now this is going to come into force?
So that's the new regulation that's coming down the line. I think it will be in play by next year at least. So I would suggest that getting ready for it now is wise. What you need to be doing is documenting that you have asked your clients their sustainability preferences and evidenced how you've incorporated those preferences into their investment selection. I think the biggest reason people are scared about asking that question is because the responses might be, oh, well, actually, now you say it, I don't want to invest in X, Y, and Z and all of these companies and blah, 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 blah. And I only want to invest in these really positive things. And suddenly you have a very skewed portfolio, which perhaps you can't even meet with your bench of options. So the important thing to do there is, before you just ask the blanket question, do the education piece. Show them what's available, what's practical, where the limitations are, and then have an informed discussion about what they do and don't want.
Yes, it's all about making sure that you're prepared in time and not last minute, isn't it? Next question.
The only thing I'd maybe add to that, Andrew, is that we obviously haven't seen everything that's come through, but if some past historic attempts at interfering in that form of giving advice or any guide, it'll be the usual car crash between the prescriptive nature of the regulations and how people actually give advice and actually engage with clients. And that would worry me.
That's always...
Track record is not strong, is it?
Yeah, no. We've got a question here for you, Philip. Now that the FCA, let's have a closer look. Now the FCA have made it a fact-finding requirement to ask and document the client's response to the question on ES funds. Do you think this will have a positive effect on the conversation for both past and future clients?
Oh, crikey, you could talk for hours on that, couldn't you? So, I mean, I think...
You've got 2 minutes.
Well, yeah, I won't. I think in general, anything that brings clients closer in to understanding and appreciating the nuances of where their money is invested is a good thing, you know. Who's going to argue against that? But there are obviously so many other important aspects to financial planning that go beyond just where is the investment. Am I saving enough? Will I have enough when I want to draw it down? Is it risk appropriate? How am I going to make sure that the people that I want to inherit it do inherit it? Am I properly protected? There are a myriad of other things that are important to that initial and ongoing conversation. And so I wouldn't want to see it given undue prominence as it happens, I tend to believe that discussions about investment prominence and investment performance should be way, way, way down the list of things that you engage a client with on an ongoing basis, almost to the point where I can't see it. There are so many more other important factors to getting good client and customer outcomes. So I think in principle it's a good thing, but I think it needs to be given the correct context.
Okay, thank you. And here's a Schroders question. How do you see greenwashing by companies with the screening? And how has Schroders adapted to its own approach to being an ESG company?
I'm going to get Emily to take that one.
Yeah, absolutely. So greenwashing is the biggest challenge, and I think the Boohoo saga highlights that. We've seen a rise of sustainability reporting from companies by, I mean, it was last year, the stat was about 700%, and it's much higher than that now. So increasingly companies are trying to get their own sustainability reports out there to give the information to investors. But obviously with them handing the information in a glossy brochure, there's going to be an element of window dressing there. I think it's important to use a number of tools to assess the sustainability of a business. First of all, the publicly available data that they are reporting, which you can grab from their annual accounts, from their reports, but also looking at more niche places. So in our ESG tools that assess companies, we look at things like employee opinions on Glassdoor, because that's all unbiased, that's the opinion of the employees. Trustpilot scores on your products and your services, because that's a direct reference that's coming from your customer base. And by looking at these more niche areas, you can get real life information about the quality of that business and how they're treating their stakeholders. So essentially you need to do a huge amount of work in looking at all these various aspects of the business. ESG data providers will get you so far. And we know there's some very reputable ones. For instance, MSCI have got a very good data set, but they only go so far because they won't look at those more niche areas as well. So you still do need to have your own more in-depth assessment as well. And you cannot beat talking to the company. If you do a site visit and go and look at their factories or their offices, talk to their employees, then you can get really good insight into the business. So that's something that we do a lot of as well.
Thanks, Emily. Philip's point about inheritors of existing client wealth being more interested in ESG than the previous generation is correct and topical. However, these younger people have no knowledge or experience of investing, and therefore both have a relatively low investor risk profile. The point being, this particular advisor is finding it hugely difficult in putting together an ESG-friendly portfolio for them, as the de facto risk-rated funds are principally at the upper end of the risk volatility scale. Any suggestions would be welcome.
Dampen it down with 30% in cash, I would have thought. would be the, I mean, I'm sounding flippant, but actually that is probably what I would do. If you're needing to take it down the risk spectrum, I think you'd obviously have it in as part of a portfolio that brings in other asset classes that are less volatile and less up the risk spectrum, and put a portfolio together that dampens it down. I mean, that would be your first port of call, I would have thought.
Can I weigh in there as well? Because I would question the providers and what they're giving you, actually, because knowing the industry, there are low volatility options where in the sustainable investment place, and we have them in our own models. We have from cautious to aggressive models, and we can populate the cautious models just the same as we would the aggressive, but through those more lower volatility options.
So do we think the industry's got some more work to do there?
Definitely, and a bit more transparency. I think perhaps maybe they just have chosen, a small handful of ethical funds to say they've met that need, but they've not done their full due diligence review of what's available in the market to make sure that they've captured every single asset class and different region and different style. It takes a huge amount of work to do that. We've got 17 people on our Sustainable Investment Committee alone who are responsible for reviewing the market. But that's meant that we've got an investable bench that covers all asset classes, all styles and all regions. So there's never an asset allocation call that we can't meet.
Okay.
Yeah, I would just echo that. We spent a lot of time with de facto looking at our recent sustainable model portfolio solution range, and really going under the bonnet as to what's in there. And obviously on the screen here we've put up just the range of solutions that we have, but sustainable models do run from a risk 3 through to 7, I think, if I'm correct. Sorry, that's terrible, should know off the top of my head. But it is about being able to populate a range of risk appetites. And I think another point there as well is there seems to be an assumption as well that it's just, not with this particular question, but it's just a kind of millennial issue. And certainly in the research that we've been doing, we're seeing a much broader age group and spectrum of people wanting to invest sustainably, and I guess that's something we've also got to take account of in terms of the solutions that we offer, and making sure that they're flexible, and that there's a full range of options available for financial advisors to use with clients.
Okay, thank you. I'm conscious of the fact that it is now bang on 2 o'clock. This is a really interesting Q&A, and we've got a couple more questions. So with your permission and indulgence, I'll carry on and ask these 2 questions. So how do you square the exclusions with the fact that, for example, BAT is a long-standing member of the Dow Jones Sustainability Index and scores very highly on diversity, etc.?
So that's where I think actually, sorry, I'm jumping in again. I think exclusions are important because BAT is good in its sector because it's better than, you know, other arms producers, etc. For British American tobacco. So it's better than other tobacco producers in terms of the way it treats its employees, etc. But its primary function is to create tobacco and to sell cigarettes. So therefore, it's not going to be palatable for a number of clients. And that's where you need your formula of exclusions of, I don't care what the judgment is on this company compared to its peers in its sector, I'm still not going to invest in anyone in that sector. And there's a huge amount of other examples. So, you know, BP and Shell in the fossil fuel industry are the best in the UK in terms of their spend on renewables, etc. For traditional energy companies, but they're still operating in an unsustainable fuel, and that's the majority of their business. So whilst you can make the case that they're better than peers, they still are operating in the sector that a client wouldn't want to own. So that's why you formalise what the exclusion policy is with your client.
Understood, thank you. And finally, Emily mentioned the success with diversity on board representation. Where will you measure future impact, though? Could just one woman be seen as tokenism and on the board? And would the board need to add more in the future? And would this also apply to areas such as ethnicity and disability?
Yeah, absolutely. So we're actually expanding our diversity engagement to cover ethnicity as well. The challenge that we've had historically is that you only really got quite clear reporting on diversity, and you've only really on gender diversity, and we've only really had that in the last few years with people kind of reporting things like their gender pay gap, etc. What the Black Lives Matter movement has done is thrown into focus the lack of ethnic diversity in the industry, and it's forcing companies to start reporting on the ethnicity of their employee base, which is great because as soon as we have that information, we can then engage on it better. So that's the next focus of our engagement activities, actually looking at diversity, not just in gender, but ethnicity as well, but also other things, so such as cognitive thought, looking at the amount of people they have with disabilities and things like that. And yes, one woman on the board is not enough, and potentially it is token, but change needs to come from somewhere. And as soon as you have one woman on the board, that becomes a bit more normalized, and then it's more likely that you will get 2, 3, and eventually you will get to that magic number of 50-50.
Well, there we are. Change has to come from somewhere, and Schroders are doing their part to make a start. Thank you very much. Ladies and gentlemen, that brings to a conclusion our session for today. Before you go, I just wanted, first of all, to thank our speakers, to Gillian, to Emily, and to Philip. Thank you, all 3 of you, for a really enlightening conversation and presentation. Thank you to everybody who posed their questions. I hope that I managed to ask all of them for you. And our greatest thanks, of course, do go to you, our viewers, for tuning in this lunchtime. I hope you found it enjoyable. If you have, let me just finish up by telling you about a couple of upcoming digital events. If you're a Scottish advisor and you want to know a bit more about what's the latest in compliance, then we're running an interesting session along with Simply Biz and Compliance First tomorrow lunchtime. You can see details of that when Joe sends you your CPD. A couple more, rather more specific events. Many of you might have been to our roadshows before. Obviously, COVID has put paid to live roadshows, but instead we're moving towards online masterclasses, the first of which is over 2 days, the 7th and 8th of September. Multi-asset masterclass, where you can hear presentations from Aegon, Baillie Gifford, Goldman Sachs, HSBC, Orbis, and Schroders will be announcing 6 new multi-asset funds. On the 27th and 28th of October, back to ESG again, and you'll be able to hear from Aberdeen Standard Capital, Aegon, Baillie Gifford, Pictet, and Schroders once again. So if you've enjoyed this and you'd like to hear some more from us, there are 11 hours of CPD on offer here, so we hope you'll enjoy them. Thank you once again for your time. We realise how precious it is, and we look forward to seeing you again soon. Thank you. Bye-bye.